JJ the CPA here. Hope you're doing well. Let's cover the employee retention tax credit. When do owners qualify? Does the self-employed qualify? If you don't mind, I want to tell you I have an employee retention tax credit seminar. You get instant access to a 3-hour video seminar with over 200 pages of my PowerPoint PDF is what you get there, as well as a number of Excel spreadsheets, how to calculate it A to Z, all the links that you need in one place, and I go over how to prepare Form 941X, which is what you send to the IRS to actually get a check back related to this. So in the body of this video, check out that link. Also, I'm going to give you something for free at the end of this video, an executive summary. I'll tell you where to go to get that. So let's talk about, in essence, what do we look at when we're making our decisions whether or not owners qualify, and their spouses and their family. So when we're looking at this, we break it into two segments. We have the definition of a majority owner, which is over 50% ownership. So for ERTC purposes, that's the threshold. So if you have somebody that's a 50% or less owner, then we segregate that out from those that are over 50%. Where we look at, in essence, for what does the IRS say about this in terms of what you can point a finger at, you look to IRS Notice 2021-49. I'm going to give you a link to that in the body of this video. The other is that you look to Code Section 267C. That's related to family, and related to spouses, you look at Section 152. So what's interesting when we're looking at Code Section 267C that deals with all the family, the relatives, except the spouse, what it indicates is that family attribution rules apply, which just means that when you're looking at how much does a family member own for ERTC purposes, you have to also add any other relatives' ownership percentages to whatever they own to come up with a total that the family owns together. And therefore, each family member is deemed to own the collective amount of ownership of all family members. Here's what's interesting. Spouses are not included in 267C, the code section. They're under the code section 152. Related to that, spouses are not then, in essence, a living relative that, in essence, allows for somebody to determine if they have a living relative. So this one's a little confusing, because what I want to be clear on is that, yes, when you're determining majority ownership overall percentage, you do add the two spouses' ownership percentages together to determine their deemed ownership. So as we now look at, well, whether or not that majority ownership, including both spouses, is more than 50%, you then have to look at whether or not there's a living relative. And if there's a living relative, then the collective ownership, if it's over 50% for spouses, then they don't qualify for the ERTC, neither one of them. But even though you add together the two spouses to get a collective ownership percentage, well, if they do not have any living relatives, then their wages do qualify. So I'm going to go through a number of examples related to this. So let's make sure we're on the same page for family attribution rules. In determining majority ownership, you include the spouse and all the family. Now, when you're determining if there's a living relative to see if there's an exception, you don't include the spouse. Now, with this, I'm going to tell you, here's the general rule, okay? The general rule is that for owners that are 50% or less, they qualify, as in their wages can be included when determining the employee retention tax credit, as well as their spouses and their family. When do owners not qualify? It's when they own more than 50%, then they do not qualify, spouse does not qualify, and their family doesn't qualify. However, there's a big exception to that. Now, it's a slim, narrow, in essence, thin line that allows for the exception, but here's what it is. If that more than 50% owner has no living relatives, then they qualify. That's interesting. So if you have a situation where a more than 50% owner has living relatives, they're not going to qualify. If they have no living relatives, then that over 50% owner is going to qualify. It's just how the law works. Check out, in essence, pages 25 through 31 of that IRS notice I'm giving you a link to. That's 21-49. Now, I'm going to go through a number of examples with you, but I'm not going to explain each one. I'm just going to tell you what they are based on a number of questions that I've gotten from you all. I do want you to know this. This is all, in essence, not my opinion. It's what's come from the IRS. So let's break it down. Does the self-employed qualify? No. Self-employed as in filing a Schedule C, filing a Schedule F. Now, if you're an LLC filing a Schedule C or Schedule F, you don't qualify. If you're a single member LLC filing a Schedule C or a Schedule F, you don't qualify. Why? Because you're not an employee, number one. You don't pay yourself W-2 wages, number two. You can't. And number three, you're not filing a Form 941 related to your earnings. So you don't have the type of income that qualifies you. Now, what about the spouse of the self-employed in the event that they're getting wages? Well, the self-employed is automatically the 100% owner. The spouse would qualify only if the self-employed had no living relatives. So when you are looking at the self-employed that pays Form 1099 to the people that are working for them or with them. So the self-employed that are not paying their people on a Form W-2, they're just paying on the Form 1099. Well, they don't have any employees. They're not paying W-2s. They're not filing a Form 941. They don't qualify. Now, the self-employed that has employees that they are paying W-2 wages to, the self-employed that is filing a Form 941, in essence related to their employees, well then they are going to qualify for the ERTC potentially on the employees that they're paying W-2 wages to. Now let's talk about, you have two spouses, they own the business 50-50. If there's no living relatives, then yes, both qualify. They don't have any family, so there's no family wages to consider. If you have two spouses and they own 50-50, but they have living relatives, then no one's going to qualify. Not the owner, not the spouse, and not the family. When we talk about two spouses that one owns 100% and one owns 0, if there's no living relatives, then they'll both qualify, both the owner and the spouse. Now you have, in that same example, two owners, one owns 100%, one owns 0. That's two spouses, that is. Then if they have living relatives, then none of them are going to qualify. If you have two spouses and one owns 60%, one owns 40%, no living relatives, okay, well then they both qualify. If you have two spouses, 60-40, and they have living relatives, then they're not going to qualify. You have two unrelated owners that own a business 50-50. They're not related. Well, then each of those owners, their spouses, and their families' wages would be able to be included in the ERTC because they're not related and they each own 50% or less. So whether they have family or not is irrelevant in that example. Now you have one owner that owns 100%. They have no living relatives. Believe it or not, they qualify. It's right there in IRS Notice 21-49. Look at those examples that the IRS gave you. It's directly from that. What if you have a one owner, they own 100%, but they have living relatives? Well, they're not going to qualify. In essence, that living relative is the big exception of whether or not a more than 50% owner is going to qualify. Now, this is from my seminar. If you have a circumstance where you have a husband that owns 20%, wife 20%, a father and a mother that own 20% each, and a daughter that owns 10%, and then you have the unrelated, let's say, individual that owns the remaining 10%. So right there you would look and you say, well, wait a minute, the husband and the wife own 40%. When you collect together their ownership, the father and the mother only own 40%. And if you're looking at the daughter, they only own 10%. So if you're looking generational there, it's like, well, no generation owns more than 50%, but family attribution rules come into play under 267. And for ERTC purposes, each one of those family members are deemed to be a 90% owner. Therefore, they do not qualify. They clearly have living relatives, so they're not going to meet the exception. So again, when you're looking at family attribution rules, it's aggregating all of the family's ownership together, and then each family member, regardless of their actual ownership, they're deemed to then own the collective amount of ownership. Now, the unrelated person that only owns 10%, their wages can be included, and if they have a spouse working for the business, those wages can be included as well. So I hope that helps. If you have further questions, what you might do is check out that IRS notice. Hopefully you'll check out my seminar. So I'm going to give you an executive summary to everything related to the ERTC. Go to the link in the body of this video, and it'll take you to a web page. You will then look for this that you'll click on that says executive summary. You'll click on that, and you'll then get the free executive summary, and you'll be able to check out my seminar. All right, hey, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. Have a great one. American CPA. CPA.